Welcome back, Chris Lioutas. We got you down here to a beautiful Melbourne winter's day, mate. Got you out of Sydney.
Thank you.
Always good when we're able to get you here in person. For any of our clients that haven't met you before, I might just get you to introduce yourself. So, Chris, I'll start and you can kind of finish us off. Work on our investment committee, but you have your own business called Genium Investment Partners, and you've got your own team. And predominantly, what you do is you help grade and sit over top of fund managers and ETFs, a number of different investment funds, and so around Australia and abroad. People that do professional investments will usually set it up in a structure, whether that be a managed fund, a listed investment company, an ETF. There's all different types of structures and reasons why they would kind of create that. And through that, clients would get access to those investments. And so you get the chance to meet investment teams out of the US, out of Europe, out of emerging marketplaces, like whether it's Asia's or India or different things like that, as well as a lot of the best fund managers in Australia. Some things that are unique that you get to do that other people might not be able to do is typically you will sign private and confidentiality agreements where you'll be able to look at all their trades and look at why they're buying certain stocks, why they're selling certain stocks, look backwards, which is kind of the secret sauce. And so you can really have an in-depth look and figure out why you rate one company above another, where they got it wrong, why did they get it wrong, where they got it right, why they got it right. But why don't you elaborate a little bit for us and tell us a bit about Genium and maybe some of the things I may have left out.
Sure, thank you. Genium Investment Partners is the name of the firm, and it's a firm that's been around for 11, 12 years now. We've grown more recently to a team of 7. We're about to sort of grow again to a team of 10. So the business is growing, which is great, adding more bodies around the table. Experienced team, so I'm actually the second youngest in the team. So most of the team has 20 years plus experience, which we think is important in terms of being through different market cycles and seeing different things. It also means the team has effectively been more seen every fund manager in the market, both locally and offshore. There's not too many new funds that are created regularly or portfolio managers that we haven't met over many, many years. So that continuity, that relationship that we've built over a long period of time means that we've got ready access to these people, both locally and offshore, and there's some comfort with these people as well. So we've known them, they're comfortable with us, they are willing to share more information with us than they would with others. And as you mentioned, with regard to our relationships and the non-disclosure agreements, it means we can get ready access to the portfolio almost in a live sort of fashion, which means we have ready look through, we can see all their holdings and what they're doing, which is critically important. And what it means that the research isn't stale. So we just don't see them once a year and then we wait till next year. We're seeing them generally 3 or 4 times a year, each portfolio manager. And then in between that, because we have access to the live holdings, we're able to poke and prod around what they're doing in portfolios, what they're seeing, why they're buying, why they're selling. And that just gives us greater comfort over what they're doing, making sure that they're sticking to their knitting in terms of how they do things. And making sure that the portfolio is constructed in such a way where we're obviously paying them to take on risk, but we don't want to take on too much or undue risk or unnecessary risk. So there's a balancing act there between generating returns, generating excess returns, and taking on unnecessary risk. So we are challenging them quite regularly on that. And the reason for that is what separates a good manager from a poor manager is generally portfolio construction. Most of them are pretty good stock pickers or investment selectors. When it comes to portfolio construction is where many of them fall afoul, and it is a unique skill set that not many hold, and that's sort of what separates the very best managers from the average ones.
Fantastic. So we're very lucky because since we set up Boutique Wealth Australia, you have been one of the main people that we've relied on for some of the consulting services around what funds we're using and why, which obviously flows down to all of our clients in the sense of how they're investing. And not only do we have you, and we spoke about that you've got 7 growing to 10 people behind you and all the research your firm does. We have Toby Lewis from Harbour Research. We've got Hayden Beamish and Will Allen from Endeavour Assets. Ironbark sits over top as the RE. State trustees, we've got Dan Rake and Stu Maunder from Freedom Finance Australia. and myself as well. So we've got quite a large investment committee that go through and look at all the funds we're holding and why. And I guess part of the reason why that's important is you might be able to confirm this, but I think there was a stat where I heard that when you combine all the managed funds, listed investment companies, ETFs, there's actually more managed funds, listed investment companies, and ETFs in Australia than there are stocks.
That's right, yeah.
And so when you think about how many there is obviously to try and figure out A, which ones do we rate at the highest category, and B, what is the pricing that they have for clients, C, if they were good, but let's say one of the managers was to leave and a guy that got them the last 10 years return is no longer there, and you're buying in off historical data, but the team that got you those returns have since left and maybe set up their own fund. It's just staying abreast of all those changes and making sure not only are we comfortable with them before, but are we still comfortable? Is the team still the same? What are they investing in? What risks are the clients potentially taking out on that portfolio underneath? But that is part of what the investment committee does. On top of that, we may want to touch on strategic asset allocation. So strategic asset allocation, there's a number of different assets. It's usually broken into 4 main asset classes. We obviously have Australian shares and international shares, being equities, property and infrastructure, fixed interest.
Yep.
So when we talk about fixed interest bonds, a lot of people may not realize that the fixed interest or bond market is roughly 3 times the size
Huge. Yeah.
of the Australian share market. The equity market. All equity markets combined is only about 1/3 of what the fixed interest or bond market kind of is. And so that in itself is a juggernaut of an asset class. And then cash,
Yep.
which we would typically refer to as almost the money that you put in the bank or other kind of things. You've got those 4 different asset classes, and there's nuances between each one and what fund manager is doing what in each asset class, and also what are we allocating, how much do we put in Australia. It represents only roughly 2% of the international share market. If we're putting more in, if we're investing in international shares, where are we investing? Is international shares just the US, or do we involve China and India and Canada and the UK and Europe and so on and so forth in that? And then also with currency, are we hedging the Australian dollar, or are we buying in their native currency, and so on and so forth? So that strategic asset allocation is another huge part around where is the money going and why.
Yep.
Well, let's get right into it then. What I kind of wanted to do today was just a bit of an economic update, and then we might touch on what we're doing in our portfolios. So I think we've touched on the investment committee, things that we look at, some of your experience. I think one of the components that is front of mind with markets right now, the big thing that probably anyone that's turning on or listening to a market update is inflation. So inflation is obviously a basket of goods that gets measured, and it's the average price. So are things getting more expensive? You know, this includes your energy bills, power bills, this includes the price of petrol at the pump, this includes the rent you might pay, this includes the value of your home that you might sell it for, this includes your wage that you might be taking home, this includes government costs kind of in total, and so on and so forth. So inflation is a basket of goods, and it's a weighted average, and how much is that kind of growing by each year. Now, the main entity that is concerned about this would be the RBA, which is the Reserve Bank of Australia, and they have a mandate to try and keep inflation between 2 to 3%. 2% on the low side, 3% on the high side, and we've come from an area where it came close to around that 8% mark, and we're currently somewhere around 3.6.
Yep.
So it is coming back, but it's still above 3%. So the RBA would like to see that come in further, and it's obviously come off high parts. One area or one tool they use to bring that in is interest rates.
Yep.
So the higher interest rates are, for anyone that has a mortgage out there, they'll know that if they came off fixed rates that may have been somewhere around 4%, and now they're paying 7% or something like that, that it really kind of hurts their budget. They're not able to spend as much on their clothing, they're not able to spend as much when they go out to eat, they're not able to spend as much on travel because their mortgage has almost doubled as far as the interest payments. Same with businesses. So households, obviously a lot of people at home will recognize it with their mortgage. If you don't have a mortgage, a lot of businesses that borrow money. So whether it's a company as big as Commonwealth Bank, whether it's a company like Freedom Finance, essentially any company out there that is borrowing money, they have to pay more for it, and it's a way where the Reserve Bank can suck money out of the economy, and that's a way where they try and essentially apply brakes.
Yep.
So we have seen the interest rate obviously drop from near 8% at its peak down to somewhere around 3.6%, but it's kind of stagnated. So it's been bouncing around that 3.6, and we're at a point now where there's a bit of pressure on the RBI on whether they keep interest rates where they are for a longer period of time, whether they hike interest rates to try and get it down to that 2 to 3% rate quicker. And it's just really trying to work about how quick the RBA wants to get inflation rates back down. So if they want it there quicker, they could hike. The problem with that is the faster you try and get it between the 2 and 3% is you might overshoot. So if they hike rates and all of a sudden businesses start going out of business, you find that leads to higher unemployment. So they don't want to go below 2%. And so one risk they may have is overshooting. But I've said quite a bit there on inflation and rates. Is there anything that you wanted to add or talk about with your kind of thoughts on what you're seeing in the marketplace right now with inflation?
Yeah, I mean, you're right. The big wins have been had on inflation in terms of getting it down from 8 to 3, and then it's gotten stuck, as you mentioned. And the real thing, when inflation does get stuck, the real thing is to take notice of what's causing it to get stuck. So the temporary elements are taking it from 8 down to 3, and then when it starts to get stuck, we start to look at more structural elements. And they might be more permanent elements. They might be elements that might be around for longer, or things that become entrenched. And if the RBA is trying to fight inflation, you do want to avoid those things becoming entrenched. And a lot of those things are around services costs, labour, the tightness of labour markets, and a few other areas. And so, as you mentioned, it's a very fine balancing act for a central bank, along with patience. So how patient or impatient do you want to be? But that balancing act is critical in that we've got full employment in Australia. Most of everybody that wants a job has got a job or a second and third job. And so if you do overshoot and take rates too high or hold them too high for too long, you run the risk of causing a recession, which is ultimately a reduction or destruction of demand, which will achieve the inflation target. But then you have significant job losses. So unemployment would go from 4 to 5, 6s and 7s, and you give up all the job gains of the last 2 and 3 years. And most central banks don't want to do that. That's not their intention. Is whilst they're an inflation fighting regime, it's a balancing act in that you don't want to be torching an economy or throwing away employment gains. And there's probably a fair degree of political pressure as well in terms of that. If you're a government of the day and you're trying to maintain a healthy economy, the last thing you want is significantly rising unemployment. So it is a balancing act mixed with some patience as well. And so what I'd say is that central banks thus far have been reluctant to raise rates any further from here. And that was sort of noted in their most recent commentary, where they said the hurdle to raise rates from here is extremely high, was the commentary used. So it doesn't mean that they won't raise rates if they have to, but they're setting a very high bar for doing so. So it looks like patience is the path they've accepted, which is keeping higher rates for longer and bringing inflation under control. But they've got to be mindful and watchful of the fact that inflation expectations could rise from here, and that does create some problems for them. So what they're likely to do from here is less action on rate movements and more action on verbal action. So trying to talk parts of the economy down, trying to be a little bit more aggressive on their fight towards inflation. So showing people and businesses that they're serious about fighting inflation rather than actually acting to take rates any higher. So that's sort of where we currently sit now, but it is something that's front and center of almost every investment market. You mentioned those asset classes before. That feeds into all those asset classes in terms of market pricing.
Yeah. So the RBA has a target between 2 to 3%. We're currently slightly above 3%. They're using a higher rate on the cost of money, and that's a tool they're using to bring it down. The reason why we're interested in this, or equity markets are interested in this, is, as I mentioned, companies borrow as well. So if we're investing in companies, if we're investing in shares, the less they have to pay for the borrowings, the more money they can pay to their shareholders, the more money they have to reinvest and potentially do more mergers and acquisitions, the more money they have. So lower interest rates is a positive fuel for equity markets. The higher interest rates hurts equity markets. So you'll probably hear a lot of people when they talk about inflation and rates, and the correlation is because equity markets are extremely interested, and if they get a whiff of that rates are going to drop,
Yep.
you'll probably find that you get a positive result in your share portfolios, your superannuation, different things like that,
Yep.
because it is very low rates are very pro the markets. Well, in saying that, so we've seen inflation kind of come up, and we've seen the banks push up interest rates. You know, there was a lot of talk about how hard that was going to be on economies because of the amount of debt people are carrying now. I know that anyone that lived through kind of the early 90s maybe saw interest rates as high as 17% here in Australia and other parts of the world, and now at kind of 4.5% or thereabouts. It's nowhere near, but obviously the amount of debt people are carrying is far higher.
Significantly, yeah.
And so each 25 bip, and also in Australia, most people are on variable home loan rates, where in America you can fix your home loan for up to 30 years. So a lot of people that were on old mortgage rates and things like that, they may have a 10, 20, or even a 30-year fixed rate mortgage. So it only affects new buyers. But in places like Australia, it typically you'll only get up to a maximum of 5 years. So most people that were on fixed rates are now off, and a lot of people are feeling the full force of that higher interest rate. We've risen interest rates from near zero. We had parts of the world that were in negative interest rates. We have seen everywhere around the globe, whether it's Europe, whether it's Australia, whether it's the US, bar some. China's one that's been lowering, but for the most part, most have been raising kind of interest rates, and yet the Australian share market is trading near an all-time high. We've seen over in the US, the S&P, the Dow, the NASDAQ at all-time highs. So why is that?
Yeah, so I think the key thing to take out of, I mean, there's been a big change in markets over the last 6 months or so, 6 to 8 months, and then obviously there was a lot of concern predating that. So if you think about the last couple of years, we obviously went through an environment where rates rose significantly. In that sort of environment, most people would assume some ensuing recession thereafter, a weak economic environment. So what you had is you had equity markets react to that in 2022. So we had them reacting fairly early to that. And then once we got to the back end of last year and central banks were sort of done with raising rates, that generally provided some comfort for equity investors in equity markets that rates were done going up. And so equity markets do forward-looking in terms of, and so are bond markets with regard to where things may be. And so what you started to see was equity markets go up since the back end of last year on the hope that rate cuts were coming. And so we haven't seen any rate cuts yet. I mean, as you mentioned, China's still cutting rates. We actually did see a more recent one from the ECB, the European Central Bank, where they cut rates slightly this week actually. And so we have seen the start of some potential rate cuts. So equity markets are forward or front running the potential cuts that are coming. The risk you've got is that equity markets will extrapolate out a certain amount of rate cuts, and if they extrapolate out too many and we don't get them, there may be some disappointment over the next 6 to 12 months. But for now, we have seen buoyant equity markets since about November last year. And that has been fed by the fact that rates aren't going any higher, which has been the central bank sort of statements, and then potential rate cuts on the way through the course of this year and next year. And so timing has been off on those sort of things in terms of there's been a lot of conjecture as to when those rate cuts may come through, but we definitely are on the rate relief path over the next 6 to 12 to even 18 months, and equity markets will rally off the back of that in the first instance. What tends to happen after that is that you tend to get some clear winners and losers after that. And as you mentioned, some companies are more rate sensitive or inflation sensitive than others. So as the market starts to take into account some rate adjustments, you'll start to see some separation in markets in terms of the clear winners and losers, and that's what we're likely to see over the next sort of 12 to 18 months. But earnings have held up pretty well to date. The consumer's still going okay, consumers still fully employed, and there's still a fair bit of consumption and demand out there. So earnings for now are holding up reasonably well, which is interesting.
Yeah, so I mean, as you mentioned, just last week we saw our friends in the North, Canada, were the first G7 country to cut rates.
Yep.
And behind that, we saw the EU follow suit, and both dropped by 0.25.
That's correct.
So where we've gone from quite a while now, where all major kind of countries, bar China, have been raising rates, we've actually started to see some of the first ones drop rates. And we've seen us now be on pause for a while, the US be on pause for a while, and talking about potentially the next rate being down, which helps companies, as well as company earnings. So when we look at any type of company and how well they're doing, you know, if they earned $1 million last year and they earn $1,050,000 this year, then and their company's earnings are growing year on year. So we've seen earnings kind of stack up relatively well in this environment, which is kind of justified what they're being paid for. That's a big thing, as well as kind of that forecast earnings. What do we think they're telling us they're going to earn next year, the following year? Probably just touching on the company earnings, we've heard a lot of talk about artificial intelligence. We've got ChatGPT, whether it's Bard or Gemini now from Google. We've seen the emergence of NVIDIA, who's just hit $3 trillion. So it was the second biggest stock in the US, which is borderline. I mean, if you don't count maybe Saudi Arabia's oil or different things like that, one of the biggest companies in the world. But NVIDIA, which is the chip maker that makes all the AI chips, just went past $3 trillion. To put that in perspective, the Aussie stock market is about 1.4, somewhere around that level. So if you add up all the stocks on the Australian stock market, you include your Commonwealth Banks, Westpacs, BHPs, Rio Tintos, Woodside, you name it, every single stock in Australia, this is more than double the size of every single stock that is listed on the Australian Stock Exchange.
Yeah.
And has had a huge rally, and it's the chip maker for predominantly most of the GPU chips that are kind of coming out. So how big is this AI thing? What are we doing to take advantage of it?
Yep.
And I guess kind of what are your thoughts for people that are interested in it?
Yep. So with regard to AI, has been around a long time, but it's largely been uninvestable. It's been a concept or a thematic, but it became investable about 6 or 12 months ago. Really was when it took wind in markets, and with any sort of change in technology or change in market dynamics, you sort of get different sort of winners winning first and second and third. So first order winners, second order winners, and third order winners. So with regard to AI, the first order winners are the chip makers. They are front and center of the advancement in AI. You need a significant amount of chips and a very specific type of chip to advance in the AI field. And NVIDIA has today pretty much the market in that space. There is other competitors, but NVIDIA with their GPUs is way ahead, and obviously the company's grown astronomically in size, as you mentioned. There is other winners from AI, so the likes of Microsoft, Google, Amazon, and the likes of those that really have an advantage in that space and have been investing heavily in that space over many, many decades. And then what the market is trying to get a feel for now, so the market's rewarding those very select companies. So we've got a market dynamic at the moment where you've got a handful of companies doing extremely well, effectively bringing the broader market up with them. But it's not very clear in the market who the next lot of winners are going to be. And so the market is somewhat guessing as to who those winners will be. But we'll get some clarity on that as we go through. I mean, it's very clear that AI is going to be advantageous to almost any industry and any business in some way, shape or form. And so what the market is trying to account for now is we've got, like I said, the first order winners, and then who are the next lot of winners going to be. And so there'll be winners and losers in that pit, I guess. And so, but for now, it's a very strong thematic in markets. It's made the US equity market even bigger, given the predominance of those companies are listed in the US. And it's also made the technology sector in the US a significant part of the market. So you're just getting much bigger in size, given their size and the drive. And they are the primary beneficiaries of the AI thematic, as I mentioned, given their investment over many, many years.
Yeah, I mean, a good example or analogy would be almost referring to NVIDIA as back in the old days of the gold rush, where all the companies that are trying to develop AI and looking what they're going to use it for, how they're going to own and sell it, are the ones looking for gold, but NVIDIA is the one that's selling the picks and the shovels.
Yep.
So anyone that's going to start digging for it needs a pick, needs a shovel.
Yep.
So they're the ones selling the chips, and this is the modern day kind of gold rush. So whether it's a Microsoft that's got the ChatGPT and putting it into their computers, their search items, their emails, or so on and so forth, or if it's other groups that are looking at how they kind of use it, but no one can essentially go out looking for artificial intelligence unless they have the GPU chips, which NVIDIA sells. Okay, we've touched on company earnings, AI. Let's jump down to property. So we've got two classes of property. We've got commercial property. So the building we're in now would be classified as a commercial property.
Yep.
A lot of the big kind of office buildings you see and commercial style ones are obviously the commercial side, and then we've got residential, which are the ones that most people would kind of live in. We've had high interest rates, and there's kind of a two-speed thing. We're finding that, especially with immigration, residential still going quite well, even though interest rates have lifted, but commercial not as well. So with work from home, higher interest rates, a lot of the buildings that we're in or things like that, they were bought when interest rates were quite low. They tend not to get the home loans you get when you buy a house that might be a 30-year home loan.
Yep.
They tend to have to renew them every 5, maybe 7 years. And so they've got to go back to the bank and work on their financing again. And sometimes the bank may pull their financing, which could force them to sell some of these large office buildings and everything like that. So higher interest rates, more people working from home means less people paying rent.
Yep.
What are some of your thoughts? What are you seeing in the commercial side of property opposed to, maybe the resi? What are some of the thoughts there?
Yeah, I mean, property is a supply and demand game, and so as you mentioned, residential, we have a lack of supply. So we've got a growing population, we've got immigration coming in, we've got kids moving at home, and we haven't got enough housing. And as we know, it takes 9 to 12 months to build new housing. So the lag time is significant, and demand coming through is too strong. So that's what's kept residential property market going, even in light of higher rates. Obviously, people being fully employed also helps. So, I mean, generally what brings in a property market, a residential property market down is people losing their jobs, and that hasn't been the case thus far. So, fairly healthy side of the residential property market, and given those supply and demand imbalances, that's probably likely to continue. The commercial side is a little bit different, like you said, where we've seen potentially an oversupply in some parts around office as well, with the work from home dynamics persisting and a few other things. So you've seen office values fall, given people taking up less space or reconfiguring their spaces to be more efficient with the space they use, given that work from home dynamic. So office has been the one that's hardest hit, and we've seen some office values fall 20 or 30% over the last couple of years. Industrial's held up really, really strongly. They've benefited from the COVID sort of work from home, consume from home trend in terms of logistics, and industrial's still holding up pretty well, though there are some weak spots sort of coming through in industrial, and that's really a function of the fact that we think back to the broader economy, retail sales have been falling, so consumers have been consuming less more recently, and with less consumption, there's less need for logistics and the online buying and that sort of stuff. So logistics and industrial have started to weaken a little bit, but still in pretty good shape, I'd argue. And the last part there is retail, so shopping centres and regional sort of malls. And they've held up pretty well because the consumer is healthy, employment's still pretty strong, and consumption's still playing out. But a mixed bag on the retail side. It really comes down to region, geography of the centre, the type of centre, the configuration of the centre. You'll notice in Australia that a lot of centres today are very different from what they were 15, 20, 30 years ago. I remember growing up, you went to a retail shopping centre and it was all clothing and footwear. Today, 50% of it would be services, dentistry, physio, doctors, chemists, and a whole range of things, big food court, movies, putt. So they have reconfigured shopping centres in Australia to make them fairly resilient, actually. And it's been very interesting to watch because that does immune retail shopping centres to a certain degree as we go through different economic cycles. That should keep them afloat better than we have seen in the past, in contrast to something like in the US where retail malls are still predominantly footwear and clothing, and they've really struggled through the last couple of years. So commercial office is probably the weak spot and continues to be the weak spot. Industrial has been very strong, retail's a bit of a mixed bag, but the resi part, again, hard to predict the resi cycle, but if everybody remains gainfully employed and we have population growth, it's always a positive for residential property prices.
Great. Yeah, that is a good point. I know last time I was in a mall, I went to go see a dentist, so I wasn't there for shopping. We might jump through and touch on currency. So anyone that heads overseas to obviously for their holidays and likes to do some shopping or different things like that, we've seen the Aussie dollar as low as around 62 cents only, less than a year ago, a number of months ago. It's now jumping around close to 67. So probably the two biggest things I think about when I think about where's the Aussie dollar going is how much is iron ore priced at, being our biggest commodity that we ship off. So I think when we see that that's at higher prices, it usually bodes well for the Australian dollar. And then also, where's our interest at comparatively to the US or other baskets? So I usually refer to people, if you were a foreigner, and let's say that you were China or things like that, and you were going to hold some money overseas. Well, if you put your money in, let's call it Australia as a bank, you're going to get 4.35%. If you put your money in America, you're going to get somewhere closer to 5.5%. And so you can get an extra 1% for holding US dollars right now than you can for investing in Australian dollars. Now, it's not the be all and end all, it's how healthy is the economy.
Yep.
Like we said, how much are you selling your resources for, different things like that. So things like iron ore and how healthy is the economy from unemployment, so on and so forth. But when the US economy is doing quite well, it's at low threes. I think it just touched about 4% unemployment. So very similar to where Australia is at the moment. And its interest rates are a little bit higher. And because its economy is 10, 20 times the size of Australia's, it's considered to be a safer area. Also, the US dollar is essentially the reserve currency of the world. So if you want to go out and buy oil, even if you want to buy Australian iron ore, it's priced in US dollars. So you buy it with US dollars. If you want to buy copper, you buy it with US dollars. And so it very much is the reserve currency of the world, hence why it tends to trade at a premium most of the time. But what are your thoughts, Con, of with currency, and what investment opportunities does a change in currency mean for portfolios?
Yep. So currency is a very hard game. It's probably the hardest asset class that we look at in terms of trying to predict. You mentioned some of the drivers already. So interest rate differentials between countries are a clear driver of currencies. You mentioned, particularly in Australia, commodity prices are a clear driver of the Aussie dollar higher, given we are a commodity country. So we're a commodity exporter rather than an importer. So if you're an importer, currency can affect you the other way. And then the third part is, you mentioned reserve currency status, but connected to that also is foreign investment flows. So we have obviously foreign investors putting money into Australia from Japan, China, and the US. As they put money into Australia to invest here, whether it's property, whether it's acreage, whatever it is, they have to convert that to Aussie dollars. So there's a big demand for Aussie dollars. The same for the US. If you're investing in the US and you're buying US government bonds or US shares, you've got to buy them in US dollars. So there's a translation effect there. So there's a demand there. And the US dollar has been the strongest currency through the last few years. It's been exceptionally strong for a long period of time now. And that has hurt some countries in terms of particularly those import heavy countries. And it has favoured America, but the opposite or the flip side to that is that when you have a really strong currency, it can make things expensive in your country. So we've had inflation in the US being rather high, but if you are importing goods, it does present itself to be a problem. So as we see the market dynamics at the moment, it looks like the Australian dollar, like you said, has reached lows of 62 cents. It looks like that's sort of the floor, I guess, for this market cycle. And the market's sort of happy with the Aussie dollar pushing higher from here. And some of the catalysts there are commodity prices have remained rather healthy, and looks like they may actually push back up. If we talked about before about the AI thematic, the AI thematic needs lots of copper, it needs lots of other resources as well, and the prices in some of those sectors have been rather depressed for some time. So there is a push for commodity prices to move higher, energy prices to move higher, so that would support the Aussie dollar from a commodity perspective. Interest rate differentials, we talked about inflation and rates, and so as central banks move interest rates, that will also affect the currency. But I think if we think about where we are in the market cycle, I mean, the US dollar's had its time in the sun in terms of being very strong, and going forward, we would expect the US dollar to start to fall away from here. Historically, it would have fallen very sharply and almost fallen off a cliff as things changed. But it's hard to see that happening this time around in terms of market dynamics, because if you are selling the US dollar in big chunks, you're then having to buy other currencies in big chunks. And I'd say the world's still pretty comfortable leaving money parked in US dollars, or the US dollar being the reserve currency status. So we see some weakness in the US dollar ahead, and the beneficiary of that should be a slightly higher Aussie dollar. How we sort of work that through a portfolio, there's two ways of working that through a portfolio. If we think the US dollar is going to fall away, then there's two options we have. We can either buy more local based assets, so we can buy more Australian dollar based assets, so Aussie equities, Aussie bonds, or we can currency hedge our global equity exposure or global asset exposure. And so we have started to do some of that already in terms of dipping our toe in the water, and there's an ability for us to increase that hedging as the Aussie dollar does push higher to protect us from any sort of currency movement. So we don't necessarily want to be taking money out of those asset markets or removing them. So the path that we've taken is to hedge those currencies as opposed to shifting money from one asset class to another.
Yep. So obviously, whenever we buy companies, for example, if we were going to buy companies in the US, whether that be Apple, Microsoft, Nvidia that we spoke about, if we're buying those with Australian dollars, we first have to convert them to US dollars. And if we bought them at 62 cents, if the currency moves up to 67 cents, that actually eats up 10% of our return. Because what's happened is it cost us more money to buy those than what we're kind of getting back. So currency can either help you out depending on which way it moves. If the US dollar is, if the Aussie dollar, if you own the international shares and the Aussie dollar starts to drop compared to the US, you're actually making more money when you convert it back.
Yep.
If the Aussie dollar increases compared to the US, you're making less money when you bring it back. So knowing what's going on with currencies, hedging for it, or at least making smart guesses there can enhance the returns of your international share portfolios.
Definitely.
Let's talk about a couple of things quickly that may impact markets and why it may impact markets, and even just some of your thoughts. And then we'll just talk about some of the things that we're doing in our portfolio. So maybe first, we will touch on a couple of things with elections. Now, before we move to the US, we've just seen a bit of uproar over in Europe. So we saw Macron do a snap election. There's been a big uprising on the far right and how many votes they're getting in over towards the EU. We're seeing that markets have obviously come off over there. We've seen that it's changed the amount they're willing to pay for the bond market over there and what price they want. So there's a bit of instability there, and a lot of this now is coming from political areas that's starting to disturb markets. And I want to maybe ask you about that. We might just get your thoughts on what's happening over in the US with the Biden-Donald Trump thing, and maybe what your thoughts are on how that might kind of play out and what impact that has on markets.
Yep. So you are right. I mean, in Europe we have seen it's the European or the EU's elections, not the European countries' elections. So the EU actually has elected officials as well. So they almost have two types of elections. And at the EU level, the European Union level, we have seen a shift to more right-leaning parties. It was predominantly left-leaning parties that were in power. We've seen a voter backlash towards right or populist parties. Effectively, that's voters saying I've had enough of current state of affairs, high cost of living, inflation, and a few other things, and wanting a change. A big spot for the Europe has also been migration or immigration as well, where voters are pushing back in some of those countries. So we have seen a swing back. That has seen France call snap elections, which is very interesting to call them that quickly. So they've got elections now at the end of this month, so within a 3-week period, couple-week period. And then we've also got the UK, obviously sits outside of the EU now, but the UK called snap elections as well, and that looks like being a bloodbath for the Conservatives or the Tories. So it looks like Labor will win a significant amount of seats there, and a landslide victory for them in the upcoming election. So interesting dynamics playing out in Europe at the moment. So swing back to Labor in the UK, a swing to the right in broader European Union elections. In the US, not too dissimilar dynamics. You've got obviously currently the Democrats in power with Joe Biden as the president, and it looks like there's going to be a bit of a voter backlash against that over the last, in terms of what's played out over the last 3-4 years. And the hot topics in the US are really inflation, so cost of living for a big chunk of the economy, and then also the border, so immigration, significant amounts of immigration across the border for a variety of reasons, and it looks like the American citizens predominantly have had enough. So any sort of polling you see today has Donald Trump winning the election, but we've got some time to go to November, and obviously you've got the counterparty in terms of ex-President Trump fighting 4 court cases at the moment. So interesting dynamic, which effectively stops him from campaigning to a certain degree. But as it stands today, polling is pointing to a President Trump victory. Polling is mixed though on the makeup of the houses. So we think about Parliament in the US. The Republicans control the lower house, Democrats control the Senate. It's a bit mixed in terms of the outcomes of those two, but it looks likely that Donald Trump will be president as current polling stands.
I think we saw Hunter Biden as well, just in his own court case, where he has been found guilty just in the last 24 hours or so as well. So you got the president's son, and you got the other president.
Former president,
so,
yep. Yep.
It's a interesting time for politics. As far as markets go, do you see a massive impact regardless who wins? Or do you think that kind of one is more pro markets or less, or is it a bit of a non-event for markets?
It's probably not an event for markets. I think that it's interesting, like both parties don't agree on much these days, but the two things they do agree on is they both hate China. So policies towards China are almost exactly the same from a foreign policy perspective in terms of sanctions and everything else. And then they're also both inclined to spend, which is interesting. So, and that's because President Trump is not what I would call a proper conservative or Republican. He's more of a populist conservative, but both intend to spend, but do it slightly differently. So effectively Biden's looking at tax increases to enable him to spend more. Trump's looking at tax cuts with a few other savings to then spend more. So they'll both spend, they're both going to spend that locally in the US economy, not abroad. So I think from a US economic perspective, it's probably it's a positive either way, negative for China either way. And then the policies in between all that are a bit mixed, but I'd argue markets probably don't care for some of the policies elsewhere. But interesting to see how that plays out. But I think for now it's a non-event as it pertains to the market. And markets are forward-looking, as I mentioned before. If the current polling is showing a President Trump win, they would have already factored those sort of things in anyway.
Okay.
Yeah.
We have two fairly big kind of wars going on. We still have the Russia-Ukraine war, and now we have, since our last talk, we've had Israel and Gaza kind of going into it. What do you see as some of the, obviously from a humanitarian standpoint, it's very sad to see, and you know, we never like kind of seeing bits and pieces like this, but from an economical point of view, what impact does this have on kind of markets?
Yeah, so I mean, from markets tend to look at conflict pretty pragmatically, to be honest. In the first instance, they'll look at conflict in terms of the risk of the conflict and sort of what it means for certain markets, and then markets will tend to move on. Where markets start to get a big concern is escalation in conflict, so escalation points, or the inclusion of other countries. So other countries get involved, markets will stand up and take notice of those sort of things. What we've seen in both of those wars now is a pretty settled environment around the market implications for those wars. But the one part of market is affected by both of them is energy pricing and oil pricing. And so you obviously got the Middle East being a significant oil supplier to the world. So any restriction in supplies or concerns around the supply coming out of the Middle East would put upward pressure on oil prices. And the other thing would be in terms of Russia-Ukraine. With Russia invading Ukraine, there's a lot of sanctions being placed on Russia now, and increasingly so. So Russian gas and Russian oil is effectively being excluded from the world market, and so you're seeing a drop in supply there as well. So there's definitely upward pressure on oil prices. In the absence of that, oil price would be significantly lower today, but we are seeing upward pressure, and that creates some problems, particularly for central bankers trying to fight inflation. If you've got high oil price, that is inflationary, and there's not much a central banker can do to affect the oil price. You can jack up rates all you want. The oil price is not going to come down because of that. So it does create a problem for central banks in their fight towards inflation, but that's probably the one aspect we're looking at quite closely, is just the energy impost and what that means, not only from an economic perspective, but also for certain companies in terms of their earnings as well.
Yeah. So obviously, you know, everything from your flights overseas, the airlines that pay more for the oil, anyone that uses a high energy cost to produce goods, transportation, to even get your food from A to B, that high oil cost not just hurts us when we go to fill our car up at the Basel, but it hurts a lot of companies that have to use any form of oil or energy cost to make or transport their goods.
That's it.
Okay, so let's wrap all that up and let's talk about our portfolio. So we've hit on a few things there. What are we looking at doing in our portfolios given what we've just spoken about? So what are some of the themes that you are seeing, and how do you see this playing out in some of our growth portfolios?
Yep. So on the growth side, I think where we've been looking at is to take advantage of certain parts of the market that have been unloved or less crowded in trade. So there's obviously a lot of focus on AI and the large end of town. So very large companies, you mentioned NVIDIA being a $3 trillion market cap company. So there's a lot of focus there, which is great, and that helps portfolios move higher. But there's other parts of markets that are being left behind. And they're not being left behind because there's anything wrong with them, they're just not in favour. The market's focus its attention elsewhere. So we are looking at other parts of the market. So in the growth portfolio, you'll find we have a fairly healthy exposure to small and mid-sized companies who are doing quite well. We expect to do well going forward, but they have been left behind by the broader market. So find very attractive opportunities and very attractive pricing in relation to what will be high growth companies and are high growth companies. So attractive point in the cycle for those. Emerging markets is another area, Asian emerging markets, where we talked about the fact that China's still cutting rates. Asian emerging markets, actually in most cases their economy is looking better nicked than Western economies. They've come out of COVID pretty healthy and now moving towards improving their economic outlook. So equity markets in those regions should do quite well, and they're trading quite cheaply versus history. So those are the sort of uncrowded or undercrowded trades that we're looking at. The other things we're looking at, we mentioned before, some hedging on the global equity side to protect from a currencies perspective, take advantage. It's both protection and adding value to returns at the same time as the Aussie dollar does push a little higher. And then some of the other areas we've looked at more recently is switching some money back from Aussie to global equities. You mentioned before that Aussie equities is a small part of markets. Aussie equities aren't exactly cheap at the moment either. US equity markets also not cheap. But if we think about Aussie market in isolation, in terms of it is a pretty narrow market, and obviously there's much broader opportunity set offshore, whether it be the AI thematic or the energy thematic or anything else. So we have looked at shifting some money from Aussie to global, take advantage of that depth and breadth in market, where you have much bigger markets, much bigger customer bases, you have national customers as well. And the last part is probably around alternatives in portfolios. And alternatives is sort of a catch-all term we use in markets to sort of cobble together asset classes that we hadn't mentioned before in terms of asset allocation. And we're looking at alternatives at the moment, and we have them in the portfolio to provide really the diversification of return and risk in the portfolio. So when markets are behaving the way they are, where you've got a lot of conjecture around inflation outlook, interest rate outlook, economic outlook, that volatility or variability in outlooks creates a very fertile environment for alternatives. And what does help them is a higher rate environment. So we do have a high rate environment for the first time in a very long time, and that does help alternatives in portfolios. So great source of diversification, differentiated return, and help portfolios, particularly where we have markets where at any particular month you could have certain parts of the market turning up or down very aggressively. These alternative strategies can take full advantage of that as we work through the market environment we're in.
Fantastic. Well, thank you so much, Chris. It's we've covered a lot off today. It's been a very interesting time in marketplaces for all the reasons we've just touched on above. But long story short, I think it's just really being around a lot of these themes, understanding them well, being in regular contact with the underlying fund managers to understand what they're doing about it, and just make sure that we're making educated guesses on behalf of our clients, and making sure that we're putting them with trusted fund managers underneath that, as you probably one of the first things you touched on, aren't necessarily just going out and betting the house on anything. They are making calculated bets on kind of companies, and doing that with a amount of risk that we're comfortable about. So not necessarily trying to double it overnight, but doing it in a way that if they do get it wrong, they're not going to lose by too much either. And so really just managing that risk while we're trying to also get that good level of return and add in that level of diversification as well. But again, thank you so much for being here, Chris. It's always a pleasure to talk to you, and cheers.
Thank you.